Hello, chart watchers and Decision Point faithful. Welcome to this Friday, June 14th, 2019 Decision Point show with your hosts, Carl and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. All right, Dad, how's it going for you today? Last night we were pretty happy. Things were going well.
Yep, doing fine.
Excellent. Okay, well, the weather has definitely calmed down. I've been complaining on Market Watchers for the past couple days about triple digits, and I'll tell you, 90 is feeling pretty cool. All right, so we're going to cover what we generally do here on Decision Point. We'll look at those broad market indexes and the scoreboards. We'll look at the price relative. And of course, the whole point of the show is to give you a weekly review of the scoreboard indexes, our indicators, but also the big four: dollar, gold, oil, and bonds. So you get a really good feel for what's going on in all of these areas to get you ready for next week. Our bonus material today at the end of the show, we're going to revisit the real estate crisis. I think there's a lot of, well, you'll see. There's a lot of parallels that are very interesting right now. All right, but let's go ahead and we'll get started right away with the Decision Point scoreboards. And as you can see, we did have quite a few signal changes this week. Not that big of a surprise given the general direction of the market. These intermediate term signals are just finally, I think, catching up to what's been going on. Whether they're indicative of what's going to proceed, past this in the intermediate term, well, we'll have to see. I think the short term, we've got all these buy signals, and the NASDAQ came in this week. It just, I don't know, it just seems like too little too late. I don't know. And here we go with our sector scoreboards. We've had a lot of shakeup here. We had a lot of red on this scoreboard last week. And since then, we've had a couple of those neutral signals switch back to buy signals. For example, consumer discretionary recently changed from a neutral to a buy. And, we like to see all that green on the scoreboards. You can see energy still is the laggard here, with the 50-day EMA still below the 200-day EMA to get that sell signal. All right, but let's go ahead and move right on into our charts for the week. And here we go. I'm going to start off, as I usually do, with the relative chart. And just so you are aware, all of these charts are available to you anytime you want with these annotations in the Decision Point Live chart list. And real easy to get to. You just go to that Articles tab, click on the Decision Point blog, and the link for that live chart list is right there at the top. So all of these charts I'm showing you are there for you later. All right, well, let's look at the price relative.
Erin, before we start, why don't we just mention that next week the Fed announcement will be out on Wednesday, which probably explains some of the market activity this week, which is waiting for the Fed.
Right. Waiting with bated breath. And yes, and then you had mentioned options expiration is going to be Friday, and that usually means a lot of volume, and you just have to make sure not to misread that. There we go. All right, so back to where we are here. How is that my cursor just disappeared in the middle of talking? There it goes. Here we are. So as you can see, we're seeing the improvement in the as far as price relative. So this is, if it's rising, that means that they are doing better relatively. That doesn't mean that they're high flying and moving upward. It just means that they're performing better than the S&P 500. And really, the big story, I think, on that chart is small caps and mid caps. They're just not really getting involved in, first of all, this rally that happened. I mean, they enjoyed some rally, but definitely not to the extent of the S&P 500. And that's what we're looking for. Notice that the readings are as low as we have seen them, for the year or longer. We're in that oversold territory. We're in that area where we usually would expect to see that turnaround, but it's just not happening yet. as far as the price charts for these broad indexes, market indexes, here's really the story with the S&P 400 and S&P 600. You can see the declining tops trend line never went up and made new highs like we saw on the S&P 500. We saw it on the Dow, and the NASDAQ 100. We saw higher highs, all-time highs, but we just never got the same result out of the S&P 400 and 600. Possible rising dollar may end up helping the mid and small caps, but so far it hasn't really made a difference. All right, this is our global chart. We look at the global ETFs, a reminder that we're not looking at the actual market indexes. So all the ETFs are denominated in dollars. So you have to consider that when we look at these. But in general, notice the nice big green line as we continue in a rising trend since the bear market move. We're making new highs, but we haven't seen that really occur, at least on these ETFs. That none of them are really challenging. I guess India has been challenging the upper bounds here, but still unable to break through. All right, let's start looking at those scoreboard indexes and signal changes. As noted, we don't have an intermediate term trend model buy signal yet for the Dow. It does look like we might get that, but of course, if we do end up seeing a breakdown in price below the 50-day EMA, well, it's not going to happen. Price will need to be above the 50 in order to get that signal change. I'm looking at a lot of flags on these charts. Those are bullish formations. I'm not sold on them. I don't know about you, Dad, but I'm not sold on them being, telling me to look for all-time highs right now. I just don't.
The advance we had just recently is because the Fed announced a comment the Fed had made, right around there, and on the possibility of lowering rates. So we're going to find out tomorrow.
Yep. And now we're pausing with bated breath.
If they do lower the rates, next week, next Wednesday, then probably see prices going higher. Mm-hmm. And if they don't, I'm not sure.
I know, right? There's the shoulds, but not always do they happen. All right, this is the NASDAQ 100. Of course, you've got the PMO buy signal, but again, we don't have that intermediate term trend model buy signal just yet. Still looks like a possible flag here. I noticed that we had a gap and it hasn't yet closed. Something to keep an eye on. All right, weekly chart. The PMOs have been heading lower, but what you're going to notice, I think that it was on all of the weekly charts for these large cap indexes, scoreboard indexes, we're getting bottoms, PMO bottoms above the signal line. That's always especially bullish, to see that sort of turnaround before, giving into a sell signal. We'll see if it amounts to anything. I mean, we had the pause. It looks kind of flat. There's not a lot of determination behind it at this point. All right, there's your OEX. It got the IT trend model buy signal, another flag looking formation. Weekly, again, pointing out the fact we're getting these PMO bottoms above the signal lines. Oh, we don't need to look at a monthly chart yet. Those have not gone final. All right, here we go. Another flag formation. This is, of course, the S&P 500, the one we watch the most closely. We did get that intermediate term trend model buy signal this week, I believe, on the S&P 500. And we have, again, that buy signal is intact. I like the way the OBV reacted to this rally. It came right back out. We didn't end up with a top here that was well above the previous top, which I really wouldn't want to see. If we have declining tops, I just soon see declining tops on the OBV, because if we see that push with volume and then we don't get the price reaction, that's what we call a reverse divergence. And it's telling us that, price should follow volume is how it's said. So if price isn't following volume, that can usually mean there's something underneath the hood.
Right now, the OBV is confirming.
Yes. Weekly, there we go. Less steep rising trend now on the weekly charts. You know, before we had them marked on the rising bottoms right here. So we've managed to make the rising trend a little less steep, which is, you know, you want to see that as well, because it's really hard to maintain those very sharp, steep moves to the upside, those rising trends. There you go, PMO signal line, bottom above the signal line for the S&P 500 as well. All right, let's move on to our short-term indicators. Curious what this chart's going to look like now that the market's closed. So I need to update my annotations as we discuss it. All right, you can see as far as volume goes, not a lot of action here. And we came back off of the new highs. We've started to see a decline there, but we ended up with somewhat of a climactic move yesterday on the net AD. Not so much here on the volume, but certainly when you have a reading, you can look all the way across. And I mean, it pokes out above that. So it's not like the most climactic reading ever. But it still was, it pointed out to me with the loss of volume as well that we might be hitting an exhaustion coming in. And we're still sort of in that area. The VIX isn't doing much for us. The only thing I could point out is that it is above its average. You can see it more even here in the thumbnail. And generally, if you're seeing the VIX you know, move above that moving average, that means there is still some faith and strength in the market underneath. And we're just not seeing the complacency as far as sentiment with those really low readings like we saw in prior rallies. All right, short-term indicators, I suspect, are continuing lower. Indeed. They hit overbought territory. They are oscillators. Not surprising to see them oscillate back down to the downside. As soon as we hit this consolidation, this pause was a great opportunity for them to turn down out of overbought territory, and they continue lower, which is not good. In general, you look for price declines there, but at the same time, if we can get it moving out of that overbought territory, it does set things up in the short term for price to rise without these oscillators getting too overbought again. Want to watch and see if we can get the oscillation back above the zero line. That would be a sign that the market is getting more internally strong, I guess would be the best way to put it. Intermediate term indicators, here we go. We're now seeing a positive reading on the ITVM, which I think is good for the intermediate term. We're still getting a rise, no twitching, no, you know, it looks pretty, you know, it's got that determination to move forward. Even on this pause, I think that's a positive development. Also seeing them above the zero line, so I'm starting to believe a little bit more in the intermediate term, just because I'm starting to see the reaction on these indicators I'd really want to see that we haven't, even during that very steep rally. All right, time to move on to the big four, and that means, Dad, you're up.
Okay, the dollar up big time today. I actually got down to the bottom of the wedge, but rallied all week. Let's got the PMO is turned up. Let's see the weekly. Weekly is not so encouraging. We've got really a long-term overhead resistance there, and it goes back all the way to 2007, which we can't see on this chart. But so I'm expecting it's going to stall up somewhere in the neighborhood of that resistance.
Finally execute that wedge.
Gold
Yeah, nice day.
break out today, but thanks to the dollar rally, that fizzled.
Mm-hmm.
It's still looking positive. Let's try the weekly. You see where the real problem is going to be just a little bit higher, up around 1380 resistance level there. PMO is turned up, it's above the signal line. And I'm doing a monthly chart today ahead of schedule because I finally noticed something on here. There's basically a saucer formation, which is bullish, and it's stretched over a nice long period. So I would say it's extra bullish. My next expectation is that the price will break out of the above the resistance and then pull back, which will put a handle on that the saucer, get a saucer with a handle formation. So that's something positive at this point.
Oil.
Oil. Now, what was interesting is yesterday they had the tanker attacks in the Gulf or the Straits of Hormuz, and the banner all day long was how oil was rallying big time because of that activity. The fact is, it had one of the more quiet days of the last month. It was up barely, I think maybe 2.5%, whereas we've had really huge moves up and down in the last several weeks here. So right now, it looks like a reverse flag to me, and could end up heading lower still. So the fact that there might be a problem in the Straits of Hormuz, it doesn't seem to bother the oil market much at all. And we have the crude oil chart along with USO, but just to give us an idea where the support is right now, there's good support around 40 to 42. And so the PMO has topped and is headed lower, below the zero line, below the signal line. So we could easily be challenging that support. Not too long.
Mm-hmm.
Treasuries last week, maybe the week before too, I pointed out a parabolic advance here. It's not a big one, but it's still the same mechanism. It gets moving too fast and gets pretty much vertical and up movement, the price does. And then the price ultimately has to maybe not crash, but fall back and break through that parabolic and kind of digest some of the advance. Right now, I was sort of thinking it might fall back to the bottom of the rising wedge, but right now it looks like it's just going to digest it moving sideways. Let's look at the weekly chart, get a better idea. Yeah, so we've got a resistance right above us, and I think it's good chance that that's as far as it's going to go. I guess it's really going to depend on Fed interest rates at this point. So if they lower tomorrow, it could send the price of the bonds higher than that resistance.
Mm-hmm.
Okay, now I have, go ahead to that chart. I've got put together something regarding the real estate collapse. And it's not the tightest presentation that you're ever going to see. But there are some things that I wanted to show you and have you observe and think about them because I don't think the real estate collapse is behind us. I think it's more like a house that owned by the Fed where they had black mold and the Fed is just painted over the surface mold and it's getting ready to turn the house even though there's still mold inside the walls. So I just think we're in a very precarious position in that. But just going back to review a little bit, we had the real estate bubble into 2005 where it topped out and with frenzy buying, and it basically they qualified everybody who should have been and could have been qualified, and lots of that shouldn't have been. And they just ran out of steam. Real estate market collapsed. Beginning in 2009-ish, the Fed attempted to reinflate the real estate market with interest rates cuts. Now, prices have returned roughly to where they were. Erin and I are in the LA area market, and it's really, they recovered to higher than they were at the top in 2005. Other parts of the country, it varies, but I could think, generally speaking, we could say that all the reinflating of prices that's going to get done has been done because it's just not much more they can do about it. Mm-hmm. There's a website that I encourage anybody interested in real estate to check out. It's called realestateDecoded.com and /Case-Shiller. They have the Case-Shiller indexes on that website, and very interesting look. And I would use some in this presentation, but copyright issues, I just really didn't know what to do about that at this point. Mm-hmm. So we really basically reinflated prices back to where they were at the top of the bubble, and give or take. And we've got, I've noticed on the Case-Shiller chart that our area, the prices have topped. And it was, if you get a general sense of what's going on here, reading the paper, whatnot, you get that impression too if you're really paying attention. No guarantees here. Again, caution, this is not the tightest presentation you're ever going to see. So wanted to look at these charts. Here we have houses sold, single-family houses sold. Notice that it's so far from the 2005 top, and it's still quite below the range, the historical range of this index. So look, all that money that the Fed sucked out of savings accounts, this is as good as they could do with single-family dwellings sold. Let's try the next one.
Okay.
A similar chart. This is housing charts. I'm sorry, housing starts. And you see that was, you see how bad it got down to 2009, and it's far from recovered in terms of what it was, at other various times in history, and certainly in 2005. So it's another.
Oh, I don't know what's going on with your sound, but I need you to speak up or closer to the mic.
Okay. Maybe I've got my hand in front of my mouth. Let's look at and you kind of wonder where all the money is going if it's not building this. Let's look at the next chart. Okay, housing index. Here are all the home builders. Now they're making money. And notice again, here's a parabolic, which collapsed, and it's coming back and recovering, but I'm not sure that that's a sign that's going to new highs. Now, moving to the next chart. Okay, this is just such a cool chart, but we've got on the left, I'm sorry, on the right, the what do you call that little chart on the right? You can see,
thumbnail.
Yeah, the dotted lines are the 1 year and the 1 month and the 3 month T-bills. They're higher than everything else except the 30-year T-bond. So we've got huge diversion here. What I really wanted to focus on, though, is you look at where interest rates were in 2006, 2007. Okay, so from the top of that to the most recent top in 2018, that's a 35% decline in terms of where interest rates were hanging, and which is 65% less power available to the Fed when they think they're going to need it. And you notice we're already heading down, and there's just not, you see how everything flattened out there from 2009 to 2016. On the bottom, you can only go so low. We've run out of room they're not going to have enough ammunition to do what they are going to want to do when things start getting shifty, I guess.
Right.
So that's what we need to be thinking about. Any comments, Erin?
Oh, I know.
No, it's.
I know. I just have to say, I mean, we talk about it all the time, especially here in the California market. It's gotten to the point even people can't rent a whole house because the rents don't go down, and we're now having people having to rent rooms that normally probably could have rented a house. I mean, there's just things are wacky right now.
Right. Well, prices, they found out in 2005, prices can't go higher if people can't afford to buy them, if they can't qualify. Exactly. And it's the same situation all over again, thanks to the Fed.
All right. Well, and on that lovely note, we will close out this show. I do want to thank all of you for being with us today. Please remember to complete that survey as you exit, because Carl and I love to get the feedback and hear what you think of DecisionPoint, what you might want to see more of. And as a quick reminder, we air on Fridays at 4:30 p.m. Eastern. So have a great weekend, everybody, and I hope to see all of you here next Friday. Happy trading.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.